So which asset leads the pack? We're going to take a look here. So right now, the price correlations between major asset classes are all trading near zero. And we've talked about this every which way. This means there are no positive or inverse relationships between any asset, which is kind of crazy when you think of it. And to be fair, there are still some inverse relationships, like, for example, the VIX and S&Ps. That's an inverse relationship. But for years, like bonds and S&P had this inverse relationship. S&Ps went up, bonds went down, S&Ps went up, that kind of thing. And now you can see the relationship is 0.09 negative. It's nothing. You know, a lot of people always say gold and S&Ps have this, positive correlation. Well, the reality is it's 0.31. That doesn't count for much. Right. And so when you look at these, soybeans, euro, crude oil, gold, bonds, and S&Ps, none of these have, they're all what we call non-correlated. Okay. This is 3-month correlation, but it doesn't matter. Not going to go back 30 years, but 3 months, 6 months, a year, same. On any given day, is there a certain asset class that can lead or drag the others, even if the correlation itself is really small? What do you think? Which asset exhibits the greatest pull to the others?
I'm going to say bonds, but I'm really taking a shot in the dark.
I'm going to say S&Ps.
Oh, that would have been I threw that out because that's the one that that's the one that everything is correlated to. I thought they were talking about another one that might be smaller than even the S&Ps.
I have to think that of these.
Well, this is what everybody's judged by. It's like me being judged by you if I'm a good trader.
Since 2010, if you look at S&Ps, bonds, gold, crude oil, euro, and soybeans, it's not going to be soybeans or euro. I don't think it's going to be gold.
For sure, it's ES. There's a no-brainer.
Okay, fine.
What about outside of ES? If we can take a look, what would you think? I don't think it's going to be soybeans. I don't think it's going to be the euro. I don't think it's going to be gold. I don't think it's going to be oil. So my choice was bonds or gold. That was my two, and I went with bonds.
My choice would be, the biggest asset class there would be bonds.
Yeah.
It'd be bonds or crude oil, in my opinion. I don't know. Of course, we're wrong. Surprisingly, gold and euro have had the highest probabilities of seeing 3 or more asset classes go up alongside them, whereas equity and bonds had the least pull. Completely the opposite.
Never would have gotten that right on the test. Could never have gotten that right.
No, not only did we not get it right.
Matter of fact, I'm disputing those results right now. I'm going to say that these results are false. I won.
Not only would you not get that right, but everything you said was exactly wrong.
Yep, exactly the opposite.
So, and mine the same, because I thought S&Ps.
Yep.
There is roughly a 50 to 60% chance that at least 3 other asset classes will move the same direction as the one you're looking at. There was a 7% chance that all asset classes were up at the same time. That's why you spread the wealth around, because there's only a 7% chance that all 5. But there is a 50% chance that 3, which makes sense if you have 6. Nothing surprising here. If you have 4 or more, 31. Yeah.
It is surprisingly. I think that's the right way to put it.
Yep. Okay, that's good. That's a really interesting page. So then the same trend continues when calculating down days. Gold and euro have the strongest pull. There was roughly a 50% chance 3 other asset classes, and the probability that all were down on the same day is only 5%. This is the reason that we diversify. 5% chance that everything's down on the same day.
Nice.
The numbers look about the same. Crazy weird. I wouldn't trade based on euro or gold. What I really like on this slide and the other one was that the chances of 5 different assets all being down the same day is 5%. The chances of all being up is 7%. That's really pretty good diversification.
It is. And, I'm trying to look back like why it would be the way they said it. It's kind of weird, too, because the euro has not rallied like with the rest of the market. When you look at, gold has rallied. It's at all-time highs. Markets rallied. It's at all-time highs. So from the study, I could see where that would be. But the euro, I guess it's a weird one for me.
Yeah, it's a weird one across the board, no question. So when the VIX is elevated, the probabilities of seeing more than half the assets move together increases to 68%. Still, gold and euro retain the highest probability of seeing the assets follow, 75% of the time in high implied volatility environments. The downside probabilities were around the same. This is when the VIX is over 20. They're just showing you that the chances of everything moving together is a little bit greater when the VIX is higher. The numbers don't change that dramatically. Let's go to the next slide. Some of the takeaways here. Out of the 6 main asset classes listed in the futures watch list on the Tasty platform, gold and the euro saw the highest probability that at least 3 others moved in the same direction. The approximate probability of at least 3 assets will move in with a specific one is roughly 50% and drops to 25% when you're looking at 4. That's why diversifying across asset classes is important. And high volatility makes the probabilities, that's spelled wrong, it makes the probabilities rise across the board, meaning that everything has a greater chance of moving together.